Gold down, stocks down, Tesla down a lot. Real estate prices up, according to the 20-city average by CoreLogic. What is going on? Jerome Powell's talking tomorrow. Let's break all of this down because there's a lot to understand. The first thing we should do is understand real estate. Now, you know me, I'm a big person about, when it comes to real estate in terms of my opinions on it and how much I'm involved in it. You already know I've got a real estate startup. We have a fundraising deadline for that tomorrow. But we'll do a Q&A like after Jerome Powell tomorrow. We'll just stay in the same live stream. We'll do a really big Q&A. I'll answer any single question anybody has about that. But let's first understand the real estate market. Right now, single-family homes are actually becoming substantially more expensive in the spring, which is great for the stuff we bought as a real estate company at the end of last year, but it's not so great for buying more. Why? What is happening? Well, this is my opinion. As we're starting to see in certain cities inventory rising, what we're seeing is buyer euphoria stepping into the real estate market for single-family dwellings. This is very different in multi, and I'll explain that. The single-family euphoria for singles, it's skyrocketing because people have finally come to terms with the idea that we're not presently experiencing a 2008-style crash in housing in America. Now, that doesn't mean we won't, and I'll give you some speculation on what may happen going forward in just a moment. But what it's telling you is that a lot of people are trying to get their hands on real estate. And this is leading a lot of folks to overpay for accessible real estate. No, not wheelchair accessible. I mean accessible as in close to the price that they are able to buy real estate for. So maybe $600,000 to $1 million, somewhere in there, this sort of range that a lot of people are buying real estate in. And so as inventory is still relatively low, and even though rates are high, there's enough euphoria to diversify away from stocks, which are being a little volatile right now, to move into real estate and buy singles themselves as either rentals or to live in. This actually has been making housing more unaffordable as prices are still ticking up from those lows of last year, and rates are also ticking up. So yes, housing is becoming substantially more unaffordable. Now, people are speculating that as interest rates come down, housing prices will go up. I actually don't think that will happen in the near term. I actually think that as interest rates come down, we'll see more housing inventory, and you'll sort of have a balanced market. But what's starting to happen may be even worse in areas like parts of Texas, parts of Nashville, parts of other areas in the country that had sort of a COVID boom. That is, we might be experiencing what I call the COVID reversal trend, which is where you have this massive surge of individuals moving to an area, Texas, Nashville, whatever, Boise, Idaho, and then you have this sudden overbuilding of new construction in that area. Then the flow of people slows down, and as the flow of people slows down, and you still have that construction with a 2-year lag time coming online, rents fall, and all of a sudden you have a lot softer market with a whole lot more inventory, and it's a whole lot more desirable to just go rent than it is to buy. That creates potential corrections in those markets that are suffering COVID reversals. And in the underbuilt markets, like the blue states that a lot of people don't like investing in, a lot of those markets are seeing way more stability because they underbuilt. What a surprise! Blue states underbuilding and actually leading home prices to rise, not fall. Not a surprise. So this is a little bit on real estate and what's happening in real estate. But it's happening at the same time as we're seeing volatility in the stock market. And now the odds are that we're not going to get as many interest rate cuts this year, if any at all. In fact, the odds are greater that we're going to have 0 interest rate cuts than the odds of us having 3 interest rate cuts, which markets believed we were going to have 3 just as of a few months ago. And at the beginning of the year, markets thought we were going to have 6 or 7 rate cuts. That's basically over now. So why is some of this over now? Well, numbers continue to come in hot when it comes to inflationary numbers, and not so hot for other numbers, which is giving fears or rise to fears again about stagflation. Look, we're nowhere near the 9% inflation and the, fractional GDP we had in 22 when we were comparing to a hot year of 2021. So of course our GDP was lower in 22. We had a technical recession, 2 quarters in a row of negative GDP. That was not a surprise. We predicted that in January of 22. That was almost obvious. And of course, inflation ran up to 9%. Yes, that felt stagflationary, but again, comparing to 2021, when we had low prices and really high GDP, that was logical. Now the fears that are regurgitating are, the decline of inflation is starting to reverse. We're getting more inflation, with GDP potentially coming in lower based on those Q1 preliminary estimates. Now, we can clean that up by saying, it was less inventory buildup. We don't need more inventory buildup because we could just call our suppliers and they've got plenty of supply available. And less exports to foreign countries. And quite frankly, this is where the data picture gets mixed because you go, real GDP estimates for Q2 were like 3.9%. So what is it? Is the economy hot or it's not? Well, the only thing we seem to know with certainty is that the last 3 inflationary reports were either on target or warmer than expected. And just this morning, we got a very important report called the Employment Cost Index, which came in hotter than expected at 1.2 versus the 1.0 expected for the quarter. 1.2 works out to 4.8% in wage gains. A lot of that, per Nick T over at the Wall Street Journal, the leaker over at the Federal Reserve, we like to say. I'll give you a big hint of what he's saying in just a moment. But he thinks that's heavily driven by unions. Now, something to know about Nick T is, first of all, he sent this really important message. And his important message was, Kevin's tendies were so nice yesterday on that call option that he played with course members. You got to check out the course member live streams, the course member trade alerts, and the course member lectures, all bundled together in a beautiful Stocks and Site course expiring today. Coupon code expires tonight. That's April 30th. So make sure if you have questions, you email us at staff@meetkevin.com. Otherwise, check out over at meetkevin.com. And if you have questions after, you could always email us as well. I do send trade alerts. I send all my trade ideas. And I give my rationale for the ideas. Doesn't mean they're always going to be a win, but boy, this Friday to Monday trade, we frickin' killed it. Let's go, 500K. We can go buy a house now. Woo! 7 children. Anyway, so Nick T actually warned that J-Pow's potentially going to lean a little bit more on the hawkish side and take this approach of do nothing, signal that no greater confidence has been achieved, and that it's going to take significantly more time to actually gain the confidence than they had previously anticipated. And that, again, is because of potentially those hotter ECI numbers, and I hate to say it, but Q2 ECI numbers, Employment Cost Index numbers, are probably going to be even hotter than Q1. That's because California is probably going to contribute 0.2% to ECI itself, so that means you potentially go from 1.2 to 1.4. Not great, because if you annualize that out, you just multiply it by 4. Now you got 5.6% annual wage gains. Sounds good, but if you have 5.6% annual wage gains, then you get states like California that are so freaking stupid, they go, prices have gone up again for goods and services and costs. Companies are raising costs again. Let's raise the minimum wage again and again and again. And you have this never-ending cycle of things getting more unaffordable, people trying to make more money and catch up to the 30% inflation we've had, but then companies raise prices even more and get even more unaffordable, and the cycle keeps going. And you never end up solving inflation, just like you had in the 1970s, which is a big cluster F. It's a disaster. It's a big problem. So hot ECI sucks. It's bad. So I really went into today before this ECI print thinking we were going to get a neutral J-POW. Now I'm kind of moving the needle a little bit to that hawkish side. I think we're probably 60-40 hawk dove tomorrow because of that hot ECI print tomorrow. So last week, I'm like, probably neutral. Some of the data's coming in soft. Consumer confidence went to 97. That is a low. That is the lowest level that we have seen since July of 2022. That's when inflation was 9%. That's how low consumer confidence is now. And they revised down the last consumer confidence number. Chicago PMIs missed. Dallas activity missed. The yield curve is getting more inverted, which is more of a signal of recession. And ironically, despite this hot ECI report, the 5-year break even, which gives you sort of a predictor of what inflation is going to be over the next 5 years, actually ticked down a tiny little bit to 2.42%, because what's happening is at the same time as we're getting hotter inflation reads, we're also getting recessionary reads. And so the market is starting to maybe start pricing in again. Oh no, what if there's a recession? Slightly. Right now, most people are not thinking there's a recession coming. But those are often the folks who realize last minute that, oh my gosh, there's a recession coming. There's a reason, let's just say, and this is not to advertise this, it's just to tell you. I put my money where my mouth is. I know there are a lot of people that don't listen to the full videos, and that's unfortunate to them because I feel like I'm very transparent with everything that I'm doing. And so there's a reason why in an ETF that I manage, we're like 19 to 20% cashola right now. We were as high as 40%. We did a little dip buying, and we expect to do some more, but that's 20% cash. Myself, I'm pretty high in cash. I've deployed a little bit in a dip over the last a few days here, and I've done some trading over the last weekish. But I still have a lot more cash than I've previously had, and that's because I think if we get a dirty J-POW tomorrow, it's probably a decent hedge to go into tomorrow with some cash. Depending on what he says will determine, are we going to have a big sell-off tomorrow? Or, and how bad is what he says? Or is he going to go, hey, you know what, we're going to reduce our bond selling, which is stimulative to the bond market, will provide some more liquidity. That's a complicated topic, but it's basically a way of saying if we get the treasury market that's screwed up, the government can't finance more debt, and they obviously love debt. They love their debt. They're going to keep financing more debt, and then you have problems. But what it's really going to come down to is this idea of, could he signal that we're going to get another hike? Methinks not. But if he does, this market's going to tank. It's really going to tank very fast. I don't think he's going to signal another hike. But he would say, hey, the door's not closed to it. He'll say that. But signaling a hike is different from saying, the door's open or closed to it. I'd like to hear him reiterate that we think we're at peak for the cycle, but it may take longer to raise rates. That would be, and depending on some of his other wording, I think we get 55 dove, 55 hawk, 45 dove, maybe 60-40, something like that, leaning towards the hawkish side. Could create a slight sell-off. Obviously, we've got earnings this week as well from Amazon and other companies. So we've got a lot to pay attention to. Earnings last week were great, but what's happening with the consumer really going forward? Can Amazon tell us? Are we starting to see a turn in the consumer? Because once the consumer rolls over, it'll happen fast in terms of how quick we'll be in a recession. Now, there'll be some sick opportunities to buy stuff in the real estate sector because I think those single-family homes might have a little bit of a poopsie-doopsie correction. Maybe, depends, might be localized. And I think the place to buy the dip right now is in multifamily. Now, if you want to know exactly what kind of trade alerts I'm sending, make sure you're part of the Stocks Insight course. There's a coupon expiring today. We got to talk Tesla in just a moment, though. But the second thing is tomorrow after the Fed meeting, I'll actually be in the studio. I want you to stick around if you're interested in my house hack, Ask Me Anything Q&A. You can literally ask anything on the internet live. So that'll be right after J-Powell finishes talking. We'll just go right into the house hack Q&A. So hope you're there. Look forward to seeing you there. Now let's talk Tesla. Look, this weekend, my butt was puckering. I'm like, oh my God, I just went... I bought Tesla calls Friday morning, and I'm like, all right. And I wrote this strategy out. I said, and I wrote this as the alert. This was part of the alert. I'm like, look, I'm going to buy about 10% of what I'm willing to buy right now. And then we're going to DCA all the way up to from a 20K position to a $200,000 position. So throughout the day, I saw that option go from like $1.90 to $1.70 to $1.60 to $1.40 to $1.20. And I'm like, this is really freaking annoying. Anyway, I dollar cost averaged all the way down. I got my cost basis down to $1.50, which is great. Why is it great? Because this weekend, two things happened. Number one, the butt pucker. I heard Elon say we're going to be spending $10 billion in autonomy spending, AI spending basically, this year. Okay, that's freaking nuts. That's nuts. I saw that and I'm like, oh my God, that's a lot of freaking spending. Now, I'm going to tell you what I think was going to happen. But first, if you're in Austin, Dallas, or Houston today, I'll be there. Make sure you go to househack.com/2024 RSVP. Okay, I'll be there talking about House Hack. Austin, Dallas, Houston, all today. Anyway, so I'm like, this is terrible because there's no way we're going to be free cash flow on this. And I'm reading the earnings call again. I'm going, bro, y'all said you think you're going to be meaningfully cash flow positive. How? No way with $10 billion of extra AI spend and training and compute. No way. So I saw that. I got nervous. I'm like, I'm screwed. My 100,000 in options will die. No. See, I was looking for, the reason I was making this investment was because I thought we'd have a quiet weekend. And I thought we would get a bounce from Friday's sell-off Monday, Tuesday before the Fed meeting. What we got was bad news and good news. FSD approval in China. That $1.50 option went to like $9. It actually went even higher intraday. It was incredible. There was a lot of money to be made there. That was great. But now what I think is happening to Tesla stock today is people are going, wait a minute, you're laying off the whole supercharger team or the new products, part of the new products team? What's going on? I can tell you exactly what's going on. They don't have enough money. Remember, like even though we had a good Q2 earnings report, nothing has changed. We still have the same high interest rates for cars. We're still going to miss on deliveries. Yes, Tesla can do it with better margins. That was a godsend. That was the lifesaver. If those margins missed, we would have had a $100 stock. They didn't miss. Knock on wood. Congratulations. What a blessing. But are rates lower? No. Is it more affordable to buy a car? No. Are we still going to see price cuts? Probably yes. Yes. Did we get a $1,000 price increase in the performance model this weekend? Yes, we did. Are we probably still going to see more layoffs and more cutting at Tesla? Yes. Is the vehicle growth rate this year probably going to be negative? Yes. Now, can they do all of that potentially with better margins? And could margins in Q2 actually improve because of all these layoffs? Potentially. But see how it's a mixed bag, right? It's not all bull. Now, and I mean like bullish when I say that. So I like to be very, very transparent with all my thoughts. I've exposed myself to Tesla nowhere near as much as I used to. And I'm just upside hedging with call options. And like I'm open to buying dips, but I don't think we need to be like mega impatient on Tesla. Though I do think there's a chance this sucker's going to run and touch $220 by June by the vote. A lot of things could change. Maybe that doesn't happen. But I do think there's a lot of desire for euphoria over at Tesla. But it's offset by potential costs and spending at Tesla and more cuts. Are they going to be able to maintain margin? How profitable and how quickly can we get FSD actually rolling money? Remember, now we're going to lap off of the FSD trials. And what we really want to see in Q2 is, please, a lot of FSD signups. Give me those $99 a month. Come on, baby, I need more of them. So, that's my take on everything that's going on, from the stock market to the Fed to Tesla, and all that good stuff. So make sure you check out that expiring coupon code linked down below. MeetKevin.com. Be there or be square tomorrow for the House Hack Q&A. I love y'all. Thank you so much for being here, and we'll see y'all soon.